Today's video, I'm going to discuss universal life, specifically index universal life. You know, people think that universal life insurance is, used for method 1, method 2, objective 3, objective 4. I'm going to be talking about its role in paying for long-term care services if you need. Make sure that you understand that I'm not going to be using the specific term long-term care insurance, which is a different financial contract. As always, the thing here is that all of the language is used and created by the carriers themselves. They've got regulations. I'm regulated, right? The language, the illustrations is very, very tough stuff. And it is bespoke. And by bespoke, what I mean is carrier number 1 will have a specific set of language. Carrier number 2 will have another different language which may look and feel similar to carrier number 1, but it's not precisely the same. If that sounds tough, there's a reason for that. It is super tough. And the reality is that Medicare is actually standardized. Federal government defines what Part A, Part B, Part D are. They give you the goalposts, the boundaries for Medicare Advantage, whether, it's subject to controversy or not. Same thing for Medigap. When it comes to life insurance, when it comes to annuities, none of those apply. And so what you end up having is you have a set of regulations on the sellers, meaning agents, producers, myself. But that is very different compared to the analysis, the understanding of what you are actually doing. There's a reason for the pay channel, because none of this stuff here, candidly speaking, is going to be released in public. No way. Because of the fact that the information here is going to be subtle. You can ask questions privately. You should. But I don't want to detract away from the function. Meaning there are valuable functions here, whether that be, for example, legacy planning, whether that be for taking care of yourself if, for example, your health deteriorates and you cannot or have decided that traditional long-term care insurance was for you. That seems like a long wind-up. I understand that, but let's get into it now. The key here then, right, is that you absolutely need to understand what you are trying to do. From there, then you can compare. The filtering then tells you, based on the key to what you've identified the objective to be. Then and only then, right? This is not a reason to stop looking. You cannot recreate this at home, right? I have spent a lot of time here on Jay's Corner trying to describe situations of when to pay and when not to. I understand. People want to get the most for their money. I'm a cheapskate. I want you to get the most for your money. That said, what you have here is, if you don't know how to make minestrone soup, right? If you don't know how to make it, if no matter what you do, you can't recreate minestrone soup, then you've got to start looking at it. Because if minestrone soup is vital, let's say, for example, I've got to have minestrone soup in order to stay alive. But guess what? I've got to pay up for minestrone soup, even if it's double the price of chicken noodle soup. Doesn't matter, right? As long as the cost of the minestrone soup doesn't make me broke. As long as it fits within the plan. That's what the ongoing conversation is for. But none of these are reasons to not look. Because simply speaking, you cannot replace the payout of insurance easily. And by the way, financial markets won't help. They won't. They cannot recreate the payout pattern. right? They cannot create the payout pattern because of something that fancy word calling correlation. And basically what this means is what happens under Murphy's Law. Your 10 shares of Jay's Rib Shack could go up by 5,000 times. But in order to help you at the time that you cannot take care of yourself, it must go up to 5,000 times at the time that you need. Both. As we know, Murphy's Law is the perhaps over cynical way of putting the flip side of that coin, which is when it rains, it pours. And during that period, this is the point here. This is why I continue to talk about other products, because they can't recreate minestrone soup. So much of the pushback that we get about the cost of financial products is that's all well and good. But if you deem minestrone soup to be important to you, your household, whatever your objectives, whatever your goals are, the generic pushback of it costs a lot don't really apply. From there, I didn't say don't eat, right? I didn't say don't eat. You'll never hear me say that. And pay for insurance. I did not say that. But what I'm saying is that, yeah, is it confusing? No question, right? These are complicated documents. These are legal, part of the legal contract. So it's going to be complicated. These graphs or these illustrations, are they difficult to compare? Yes, absolutely. But the fact of the matter is, if it's filling a function that you need, then I'm telling people, look, it's worth it. The market is highly competitive, as you can see, $2 a month. And the last part is the punchline, which is, as you can see, I'm going to start to highlight it here. The world changes. It has happened to be that the reality is that the pricing of life insurance has improved because interest rates are higher. There's a reason I say stocks for show, bonds for dough, right? Which is, since interest rates are higher, what happens is this orange here has increased, right? Because now interest rates are not zero, meaning that some of the indices that you can go in here that are described in the illustrations can go into higher interest items, and that then can accumulate. So that's number one part of the world changing. That said, on the negative are these two, which is the regulations for insurance products has gotten tighter, no question. In addition to that, we've got new alternatives now that are not superior to the past. To give you an idea of an illustration, if we take a look, and this will be the last comment I'll make, we used to have on the planet where this type of policy, where you have both the life insurance plus the ability to bring forward the benefit, we used to have it such that under no circumstance could it ever go to zero. This entire body here on the far left column, this didn't happen, meaning that always, even under the guarantee, you would get the benefit, even if you did not require a pull forward of benefits, even if down here your orange was zero. As long as you paid the premium that we had calculated and estimated, then you could still have both. The punchline to that is that the world changes, and just saying, okay, well, we'll get to it tomorrow. Maybe interest rates could be higher, but these things here, you wouldn't know are happening. You wouldn't be responsible to know. The idea, of course, then the ultimate result is your focus that once you've identified the objective and whether or not it fits, then you start asking questions and ask aggressively because of the fact of the world changing, the pricing inputs changing. You don't have to worry about the competitiveness of the sellers. I've already illustrated it to you. Like I said, can we come up with 5 more sellers within $5 a month? Probably. that competitive. All right, before I go down another wormhole and we start talking for another 3 hours, I'll stop it here. info@gh2benefits.com. That's the place to ask your questions. Obviously, it should be obvious to everyone that everything is confidential, 100% confidential. Your name, your location, your situation, all independent, irrelevant, candidly, right? Because a single tweak here, I just wanted to tell you, you change yourself to male, you change yourself to 63, you change yourself to 55, the entire situation will change. The carriers that I show you as alternatives will all change. All of them. Very good. Thanks for joining. Thanks for watching here to the end. Be sure to tell someone else about Jay's Corner.